Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, April 14th, just after the close. In terms of this week on the equity side, a grind to the market, but maybe a little bit of good news out of the banking area with JP Morgan's numbers and comments this morning. And you saw similar out of Bank of America and a couple others. Maybe enough to just let the banks get their feet under them a little bit. As you know, in discussing over the years on these videos, I tend to think it's difficult for markets to continue to march ahead without banks and financials. They can tend to be a drag longer term on the market. So it'd be nice to see them get their feet under them. In terms of what worked within the portfolios this week, it's funny. In our U.S. ETF portfolio, that gold and silver has been a very nice trade. Those miners we talked about going back 6-8 weeks ago. Little weakness today as they got quite overbought from a weekly standpoint. But very interesting. It's interesting to see the precious metals working as inflation fears start to ebb a little bit, right? For years, you tended to think of gold as an inflation hedge. Yet, at the peak of the inflation numbers last year, gold couldn't get out of its own way. Now, as inflation starts to come in, starts to ebb, we're seeing a little bid to gold. Part of that is because as rates come down, gold doesn't give up that interest rate piece, right? Gold pays no dividends. So if you're able to earn 4 or 5% on your money, gold may not be as attractive as if you're only earning 2 or 1% on your money. So we'll keep an eye on those precious metals. In terms of value and growth, saw a little bid come back into value. We're starting to see that now. We saw in March growth really overtake value. Starting to see value creep back, and growth and value in some of our relative strength, longer term work are about even right now. Keep in mind, shorter term, growth has been where the strength is as the market, as investors and traders try to look through the Fed hikes to either a pause or a cut, whenever that may be. That may be 6 months from now, 12 months from now, 18 months from now. It's served us well to have the opinion, and John Mousseau's been of the same opinion, that these cuts are way out there. We started hearing 6, 8, 10 months ago, people talking about cuts the first quarter of 23. That was a pipe dream. And we said at the time, if you're buying stock on that, be careful. There are plenty of reasons to buy stock, but that's not one of them. What's working this year? I want to put up a chart on the equity side because it's interesting. For the last decade, 13 years, very difficult to make money in the international markets. There's been plenty of false starts. We're starting to see the recent strength in international markets continue a little longer than it has the past decade or so. As on that chart, you can see on the left-hand column, or the first column, that's the Americas. That is North America, Central America, South America. Look how well Latin America's traded. Mexico up almost 21% on the year. Second column, Asia Pacific. Taiwan with a nice bounce. South Korea with a nice bounce. Europe has been a monster. If we go back to last year, I remember specifically talking about, on this video, talking about one of our investment meetings, our investment committee meetings. We have them weekly. And we were talking about Europe. And we're talking about Great Britain specifically and how difficult a time they may be having going forward from a GDP and economic standpoint. But, and here was the big but, they're trading at 6 times earnings with a 4% dividend yield. I hope they're going to have a bad time going forward. That the stock's already telling you they're having a bad time going forward. They could have negative growth going forward, and it was cheap. So now, just as we see from time to time, when things get priced for catastrophe, you don't need much to get a security moving the other way. And you're seeing while Great Britain has their struggles, and Germany has their struggles, and Spain has their struggles, and France has their struggles, they're all ripping because they had gotten cheap enough that they had discounted just about all the bad news economically that they could. So keep in mind, it's been a long slog to try to make money internationally. Don't fall into the scenario that a lot of us do and have a recency bias. Take a look and see if there's anything that can complement your domestic holdings. In terms of fixed income this week, and we can't say fixed income without talking about inflation, seems like those reports that we saw this week, whether they were CPI or PPI or even retail sales, have given us at least a basis to feel that inflation is starting to dampen. And if we can continue to get some of these monthly readings, it'll be positive for both the fixed income market and the equity market. Remember when the bond market was on fire yield-wise last October, John was talking about being able to buy 5% munis and very high quality corporates in the 4s, treasuries in the 4s. Well, we're starting to see that reverse. 10-year treasury closes today at a 352, 30-year at a 375. Even though that's up for the week, it's in that range where it's trying to find the handle on where inflation will peak or has peaked. In terms of munis, yields were actually down this week. Part of that is a supply scenario. There's not a lot of new issuance. Municipalities have not had to issue because they were large issuers in 21 and 22. We do see some supply and some new issues coming on the market next week. So the muni market will get tested in terms of the demand to soak up that supply. Well, everyone have a great weekend. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos.